Hello everyone and welcome to today's session. If you've ever asked yourself, how do people make money with stocks? You're in the right place. Stocks are one of the most well-known ways to grow wealth, yet many beginner investors find them confusing. Today, we're going to break down everything you need to know, step by step, from understanding what a stock is to the strategies people use to make money consistently. By the end of this video, you'll understand the fundamentals of investing in stocks, how investors earn money, the risks involved, and how you can get started as a beginner. So relax, get comfortable, and let's get started. So what exactly is a stock? To make money with stocks, you first need to know exactly what a stock is. A stock represents ownership in a company. When you buy a stock, you are purchasing a small piece of that company, called a share. This means you own a fraction of the company's assets and earnings. Stocks are issued by companies to raise money for business growth, such as building new facilities, hiring employees, or investing in research. By selling shares to investors, companies gain the money they need without taking on any debt. For beginner investors, it's important to understand that owning a stock doesn't mean you run the company. Instead, it means you have a claim on a portion of its profits and assets. There are two main types of stocks you might encounter. Common stocks. These give you voting rights in company decisions and the potential to receive dividends. Most beginner investors start here. Then there's preferred stocks. These usually don't provide voting rights but pay fixed dividends, making them somewhat safer than common stocks. Understanding the type of stock you own is the first step in understanding how you might make money with it. So how do people make money from stocks? Once you own a stock, the next question is, how does this ownership translate into money for me? There are three primary ways investors make money from stocks. The first is through capital appreciation. This is when the stock price increases. If you buy a stock at $50 and sell it at $75, your profit is $25 per share. This is the most common form of profit in the stock market. The second way is through dividends. Some companies distribute a portion of their profits to shareholders. This can be paid monthly, quarterly, or annually. Dividends can serve as a passive income stream. And the third way is through stock buybacks. Occasionally, companies repurchase their own shares from the market. This can increase the value of remaining shares, indirectly increasing your wealth. For beginner investors, it's important to recognize that most of the money made in the stock market comes from long-term growth rather than trying to time the market. So what determines the price of a stock? A critical question is, why do stock prices change? Understanding this is key to understanding how money is made. Stock prices fluctuate based on supply and demand. When more people want to buy a stock than sell it, the price rises. Conversely, when more people want to sell than buy, the price falls. Several factors influence supply and demand. One of these factors is company performance. Strong revenue, profit growth, or successful product launches often increase demand of a stock. Another factor is market sentiment. Investor perception can drive prices, sometimes even more than actual performance. Another factor is economic indicators. Interest rates, inflation, and company growth can affect stock prices broadly. Another factor is global events. Wars, pandemics, and political instability can cause sudden market shifts. For beginner investors, the key takeaway is that stock prices are not fixed and fluctuate based on both tangible results and human perception. So what are capital gains and how do they work? One of the main ways investors earn money is through capital gains. But what does that mean exactly? Capital gains occur when you sell a stock for more than you paid for it. For example, you buy 10 shares at $20 each, which would cost a total of $200. A year later, each share is worth $30. If you sell all shares, your return would be $300, making your capital gain $100. Capital gains can be short-term, less than a year, or long-term, more than a year. This distinction is important because tax rates often differ between short and long-term gains. Beginners should focus on long-term investing, as it tends to reduce risk and maximize gains through compounding. So how do dividends work? Beyond capital gains, dividends provide another route to making money. So, what are dividends, and how do they work? Dividends are a share of a company's profit paid to shareholders. Not all companies pay dividends, but many stable, established companies do. For example, You own 50 shares of a company paying $2 per share in dividends annually. You receive $100 in dividend payments each year. Dividends are particularly valuable for long-term investors, as they can be reinvested to purchase more shares, compounding your returns over time. Reinvesting dividends can dramatically increase wealth over decades, even if the stock price itself doesn't skyrocket. So how do people make money by trading stocks? Another question is, can you make money by buying and selling stocks frequently? The answer is yes, and this approach is called trading, and it differs from long-term investing. This is when traders attempt to profit from short-term price fluctuations. Common trading strategies include day trading, where investors buy and sell stocks within the same day. Profits come from small price movements. Another strategy is called swing trading. This is when you hold a stock for days or weeks to capture short-term trends. Another strategy is called momentum trading. This is when investors acquire stocks that are moving strongly in one direction. While trading can be profitable, it is riskier and requires more experience than long-term investing. Beginners should be cautious and consider simulated trading accounts before using real money. So what are some risks that beginner investors should be aware of? Before you start investing, it's crucial to understand, what are the risks of investing in stocks? Stock investing offers high potential rewards, but there are risks. Stock prices can fall due to economic downturns or company problems. This is considered to be a market risk. Some stocks may be hard to sell quickly at a fair price. This is considered to be a liquidity risk. Rising inflation can erode investment returns. This is considered to be an inflation risk. A company might fail or underperform expectations. This is considered to be a company-specific risk. Some risk management strategies include diversification, long-term investing, and researching companies before investing. Beginners should always start small and gradually build experience over time. So what is diversification and why is it important to understand? One of the most common questions beginner investors ask is, how can I reduce risk? The answer is diversification. Diversification means spreading your investment across different stocks, industries, or asset classes. For example, instead of buying only tech stocks, invest in healthcare, energy, and consumer goods. This way, if one sector underperforms, your overall portfolio is less affected. Diversification is sometimes called not putting all your eggs in one basket. It doesn't eliminate risk, but it reduces it significantly. So how do people make money consistently over time? Many beginners wonder, can people make money in stocks consistently? The answer is yes, but it requires a long-term strategy. Most successful investors invest regularly, even small amounts, focus on companies with strong fundamentals, and reinvest dividends. Avoid emotional reactions to short-term market fluctuations. Compounding plays a big role in investing. For instance, $1,000 invested today could grow to tens of thousands over decades if it earns an average annual return of 7 to 10%. This is why patience is one of the most valuable traits for investors. So how do I get started as a beginner investor? Finally, the question on every beginner's mind, how do I start investing in stocks? Here are the basic steps. First, educate yourself. Learn the basics of stocks, trading, and investing. Next, you're going to open a brokerage account. Use reputable brokers that support beginner investors. Start small. Begin with a modest amount to build confidence and experience. Next, choose a strategy that best aligns with your goals and intentions. Decide whether you want to trade, invest long-term, or both. Make sure to diversify. Avoid putting all your money in one stock. Most importantly, monitor and adjust. Track your investments and adjust when necessary, but avoid overreacting to short-term changes. The key is to start now, even if it's a small amount. Growth over time in the market is the most effective and consistent way to grow your investments. Making money with stocks involves understanding ownership, capital gains, dividends, and risk management. Stocks can provide significant wealth over time, but it requires knowledge, patience, and consistent investing. Stocks are powerful tools for building wealth, and by understanding the basics, you can make informed decisions and start growing your money wisely. Investing isn't a sprint, it's a marathon. Start today, stay disciplined, and your future self will thank you. Thanks for watching. If you found this video helpful, Make sure to like, subscribe, and check out our channel for more amazing videos that can help you grow your investment portfolio.